In the middle of February, just a few months ago, before this pandemic took a wrecking ball to the 10-year historic bull market that just ended, it's almost easy to forget that the market had reached its all-time highs. And along with that came an awful lot of traders and investors, many like you and me, who were sitting on huge gains on stocks they were long and were really not interested in giving those profits back. I'm the head trader of SMB Capital's options trading desk, and I can tell you from personal experience that the traders in our firm were faced with this issue in a serious way. In this video, I'm going to run you step by step through a way that options could have been used to turn an incredible equity trade into a spectacular options trade just by using some very simple options trading concepts that I think you're going to find pretty compelling, so stick around.
Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable.
As most of you know, one of the most popular trading stocks over the last 6 months has been Tesla. In mid-October, Tesla took off to the upside, starting at 250 and nearly quadrupling at one point, up as high as 968 in early February. You'll then see that the stock was pummeled by fears of the COVID-19 epidemic destroying the world economy, and a month later, it was down to 350, only to turn around and double off of that point by mid-April, back up over 700 as the market fears began to subside. Well, there are traders around here who stayed long Tesla from late last year through mid-February, who were sitting on huge gains just as the seriousness of this pandemic was beginning to dawn on the financial markets. Okay, so let's say that there was a trader who was sitting on a large gain in Tesla in mid-February with the following quandary. Let's say that trader had a large gain in Tesla and might not want to sell his Tesla position because he's very high on the stock and he thinks it ultimately has more upside. If he sells his shares now, he'll take a large capital gain on those shares, and the tax hit from that will be substantial. Yet at the same time, there were a lot of traders out there sensing the impending storm which was emerging as a result of the pandemic, and so they were faced with a bad choice: either ride out a potentially massive sell-off in Tesla or sell the shares and take a sizable tax hit on the capital gain from the great trade. So let's take a look at a really compelling alternative that would have been available to a trader in that position because of the unique nature of options and the enormous help that they can give to equity traders in situations like these. Okay, so let's go back to January 13th, and you can see on that day that Tesla had broken above 500 for the first time, and so a typical swing trader could have sensed a breakout here, and so he might have entered a long stock position in Tesla. So let's say that a swing trader decides that this move is the start of something substantial in Tesla. So he goes ahead and buys 400 shares of Tesla at 502.52, which is where Tesla was trading on that day, January 13th. And as we all know, that would have been a good call. And by February 4th, Tesla made an explosive upside move. And in less than a month, his 400 shares, which originally would have cost around 201,000, are now worth upwards of $364,000 for a gain of over 163,000. At the same time, this is a trader that would have begun to hear rumblings of this growing virus threat in China. And so he could have easily looked at his substantial gain and asked himself, am I ready to close this trade? And if the answer was no, because he felt there's more upside on his Tesla shares, but at the same time, he's troubled that he's sitting on a huge gain that was at risk given the storm clouds that were beginning to form in the market, he might ask himself, are there any option strategies that I can employ where I can protect my profits at a reasonable cost? And the answer, fortunately, is a resounding yes. There are not only techniques for protecting your profits, but they can be structured to have no cost at all. Now, before we get into exactly what could have been done with options at this point, which I think you're going to find intriguing,
I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective technique that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
So getting back to our trade on February 4th, this long Tesla share trade is up over $160,000. And understandably, you'd be thinking about how to preserve those profits without exiting the trade. Now, before we can structure a trade like this, a trader needs to ask himself two questions. The first question is, if Tesla turned around and sold off at this juncture, at what price would a trader be happy to own 200 more shares of Tesla? So let's suppose that a trader was willing to add 200 shares to your position if Tesla sold off down to 650. The second question would be, at what price would a trader be convinced that Tesla is overbought and you'd be more than willing to close your trade and sell your current shares, all 400 of them? And suppose that your answer was, if Tesla gets above 1060, you'd be willing to look at selling and taking your profit. So once we answer those two questions for ourselves, we can put together the hedge. Now, before we get into that though, I wanted to make certain that anyone watching this understands how puts and calls work on equities. Otherwise, you won't be able to follow this example. For those of you familiar with puts and calls, please bear with us. This is going to be brief. Then we'll jump back into this remarkable options hedge that could have been constructed in this exact situation. Most of you have probably heard of a call, which is a security that allows a trader to buy the right to purchase 100 shares of a stock at the strike price of that option before that option expires. So for example, the April 17th Tesla 1060 call entitles the buyer of that call to purchase 100 shares of Tesla at 1060 per share. Anytime before that option expires on April 17th, he can exercise that. Now, a put option, on the other hand, entitles the put seller to sell 100 shares of a stock that, say, he already owns at the strike price of the put option at any time before that put expires. People will frequently buy puts on stocks that they own where they'd like to lock in the lowest price that they could sell their shares for to limit their losses if the stock goes down. So for example, if someone owned an April 17th 820 Tesla put, if Tesla really tanked, they could sell their shares for 820 no matter how low Tesla's stock price got. So generally speaking, a call option on a stock goes up in value when the stock rallies because a call option is the right to buy shares at a fixed price, and that right gets more valuable as the stock price gets closer to the strike price of that call. Similarly, a put will generally become more valuable when a stock's price has gone down because the right to sell shares at a fixed price gets more valuable as those shares drop. Okay, so let's take a look at what we could have put together that day. Let's start at the top on the call side of the proposed trade, and you'll see that we sold 4 calls at 1060, and then we bought 4 puts at 820, and we also sold 2 puts at 650. Now, let's really break down what's going on here and why. So first off, on the call side, we're selling those 4 1060 calls. Well, if Tesla closes over 1060 when the options expire, we'll be required to sell those 400 shares to the call buyer for 1060, which is the exact price that he'd hypothetically be willing to sell the shares for anyway. Remember, each option represents 100 shares, so 4 options would remove all of the shares at what you'll remember was the upside target price on the shares. Then we went down to the put side and bought 4 820 puts. Now, Tesla's trading at 911, so those puts would have value if Tesla dropped down below 820, which is 91 points below the current market. So you'll remember we're up over $160,000 on the trade. So if Tesla closes below 820 on expiration day, the trader would exercise his put and sell them for 820, which is giving up 91 points on each of his shares from the current level, or a total of about $36,000 in profit given back on all of his shares. So obviously you wouldn't like that, but if that did happen, you'd still have about $125,000 of profit left on the Tesla shares. Remember, with a hedge, you're looking to lock in most of your profits while still giving yourself some room to make more if the shares continue to climb. Then finally, you can sell 2 of those 650 puts. Remember, in this scenario, you're willing to increase your position in Tesla if the stock dropped to 650. Now, significantly, I'd like you to take a look at this transaction from another perspective, which is the cash flow of this transaction. So first of all, we sold those 4 1060 Tesla calls, and those were priced at $91.70. And remember, all options represent 100 shares, so you multiply that by 100, and we sold 4 of those. So that totals $36,680 of positive cash flow on the 4 calls. We then bought those 4 820 puts for $93.13. So those 4 caused a cash outflow of $37,752. Finally, we sold those 2 650 puts for a total cash inflow of $69.84. And so if you add it all up, we have more than $6,000 of cash inflow from this hedge. So to summarize, we just got paid $6,412, yet we simultaneously protected more than 75% of our profits on the Tesla shares, with the only proviso being that if we hit our target profit on the trade, we'll sell our shares at our target, which we would have done anyway, and we'll buy 200 more shares at a price we love if it drops below the current level. So even if all of the options expire worthless, we just got paid over $6,000 for this hedge. Remember, you usually pay for hedges. This is the reverse. This is getting paid to hedge. It's amazing if you think about it, but there's more to this story. Let's move forward now to March 17th. So on this day, the market was getting pounded as it had been for the previous month since the middle of February, and Tesla had dropped to about 400, more than 500 points from where we had added this hedge. So let's take a look at what happened to our options pricing on that day. So first of all, with Tesla now down 403, understandably, the right to buy them at 1060, those 1060 calls, they have almost no value. Remember, we got paid over $90 for those calls, and now they're worth less than $2. And the 820 puts that you bought for a little over $90, well, those are now up over 400, more than quadrupling in value. So you'll also notice that the 650 puts have gone up a lot, but as we will be taking no action on those at this time because our plan is to buy 200 shares more of Tesla. If Tesla closes below 650 anyway, there's no action to be taken at this point. So what we can do right now is to close those 4 calls, buying them back for almost nothing and closing those long puts at 820 for a tremendous profit. So let's take a look at those 2 trades in isolation. So as you can see, as we mentioned before, the original trade netted us positive cash flow of $6,412. There was a small cost to closing those 4 calls because they shrunk so much. So they did cost us a total of $572 to close, but obviously that's a small amount. But take a look at the cash flow from selling those 820 puts. We brought in over $167 in cash from those 4 puts because the price of them had ballooned to $419. After all, Tesla was trading at just over 400, so the right to sell them for 820 is obviously extremely valuable, and thus selling those puts at this stage locks in that huge increase in value on those puts. So now the cash flow from just the options portion of the trade is up over $173,000, and while they've lost value, we still own those original 400 shares of Tesla. Now, let's move forward to April 17th, and you'll see that Tesla closed at 754 on the options expiration day. So remember, in this case, we're still holding those 650 puts, but with Tesla closing at 754, they expire worthless. Why? Because what's the value of the right to sell your shares at 650 if the stock is trading more than 100 points above that? No one is going to sell them for 100 points below the market, so those puts expire worthless. So let's examine what has happened here by pulling this all together. So you'll remember that when we wanted to put this hedge on, Tesla was trading over 900, and so the total value of these shares was over $364,000. But by April 17th, those shares had dropped in value, as you can see, by over $62,000. But remember, you would have made a huge profit by selling those 820 puts that you were long as the key part of this hedge. And you were also able to close the short calls for almost nothing. So there was a tremendous cash flow gain from the hedge of over $173,000. So if you add it all up with the cash you would have made on the hedge and the drop in the value of your Tesla shares, you would have come out way ahead. So now after a drop in Tesla, your total trade is way up to a value of over $475,000. Putting it another way, had you not bothered to put the hedge on at all, your shares would have dropped from over $364,000 to $301,000. But by utilizing the power of this hedge, you not only were able to protect your position from, at worst, a 25% loss in profits, you would have been able to make a tremendous profit on the hedge itself. So the overall gain on the trade exceeds the value it had before the hedge was put on in the first place, prior to the drop and subsequent rebound of the Tesla shares. So what is the huge lesson from this video? Well, most traders think of hedges as a necessary evil, a cost that if nothing bad happens, you lose, and if something bad does happen, you still lose, but not as much as you had you not put the hedge on. Well, with options, that paradigm completely shifts. As you can see from this example, you not only can bring in cash flow initially with a properly structured hedge, but you can end up cashing it in a big way if you understand the nature of options trading.
Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.